I like to introduce the group of the presenters dealing with the first presentation. The title is Climate Finance Framework and the Role for Actuaries. And it is, as I learned, about reporting about the activities of a working party, a dedicated working party at the Australian Institute of Actuaries. They have been starting doing that work maybe 1.5 or 2 years ago, and we are happy to hear what they have been come up with and what is left to be done still. The stage is yours. I would like pretty much some words about the presenters. We have Alison Drill. She is heading PC Structured Solution, Asia and New Zealand. She's obviously an actuary with a lot of credentials. I will not go into the details as it takes too long. Then we have Kate Lyons, also a very experienced actuary. Over 20 years of experience, I learned. She works with insurers and with governmental entities in insurance risks. And then we have on the panel Ramona Meyricke. She's also long-lasting experience in that field. And then we have Sylvia Wang. He's working for an insurance company as a general insurance actuary, as a master of actuarial science and in data science. The stage is yours, ladies. Please start your presentation.
Thank you very much, Dieter. Hoping everyone can hear me okay. I'll just move the mic a bit closer. It's great to see so many familiar faces and new faces with us today. I think one thing that was really quite clear in the conversations this morning and the panels was that there's a lot of action required, and we'd like to focus on the fact that there's a lot of investment required in the years ahead or the decades ahead. And we're seeing a lot of money directed to climate finance globally. And I looked at this study here back in 2017-18. It was the most recent study I could find that studied where all the climate finance is going across the planet. Where are we directing most of our finance? And what was really clear is that actually it's largely going into transition investment, the investment in emissions reduction. And that's great because we do need investment in that space. But the second cousin, the poor second cousin to that investment is investment in adaptation, particularly adaptation of our built environment. And this is something that insurers really care about because it's a driver of the cost, because the cost of extreme weather and natural disasters is growing. So how do we reduce that cost? How do we stay relevant to society today? We do need to look at emissions reduction, but we also need to adapt to the climate change that's already baked into the system. So we set out as our working group to look at this problem and try to understand why we can't attract more finance into the adaptation space. And when you start looking at some of the big, expensive global studies that are done, you know, the numbers do start to stack up. We do think this study was really interesting from the Global Commission on Adaptation. And when you think about the avoided losses, the economic and social investments, the things that are more in the non-financial space, the things that are hard to quantify, and let's face it, we're looking at costs that we can measure today, but benefits that go over many generations or decades ahead that are hard to quantify. But when we do see these systemic, material, large studies that have got a lot of investment behind them, and they think about the social benefits and the economic benefits, something like a 4-to-1 ratio does play out in some of these big studies. And so it's interesting then to think about the Australian context with these sort of numbers. And Deloitte has really been leading the way in some of the econometric and climate modelling here in Australia. This first study that I see on the left is where the National Australia Bank worked with Deloitte and focused on the costs of decarbonising Australia. And they focused in on the high emitting sectors here: energy, mobility, raw materials, manufacturing, food and land use. And the thing that stood out for me about the study was that it was saying, well, look, there's going to be a certain amount of capital expenditure over the coming decades. When we renew or replace what's already there, can we do it in a smart way so that the incremental cost of reducing emissions isn't so material? And they focused on this idea and concept of a smart reallocation. So through an orderly transition, when we do replace existing capital expenditure items, let's do it in a low emissions or no emissions way where we can, and electrify. And if we are quite smart about this sort of decarbonisation of our economy, the actual incremental cost of climate emissions reduction could be more like 420 billion over the next 30 years. And that's actually only about 14 billion per annum, but it's a lot less scary a number than some of the big trillion high numbers that get thrown out there when you think about the whole cost. The other study that's got a few points up there was commissioned by IAG, who considered the financial costs of insured losses, non-insured losses, but also focused in on the indirect and social costs they could quantify. And I think it's really interesting to note that they tried to capture those non-financial benefits, but there's still a lot that they couldn't quantify in that study. For example, permanent unemployment, education disruptions, loss of social cohesion, costs associated with higher crime rates, environmental degradation, and the loss of animal lives. So even with these large numbers and studies trying to capture some of the social benefits, they still haven't captured all of it, and they're sort of unquantified. But I think the system-wide studies really demonstrate that there's a strong rationale for climate finance, both in emissions reduction, mitigation, and also the adaptation of our physical assets in our societies. And the benefits of adaptation investment can provide that benefit of 4 times the money spent, at least. Yet the challenges are there, sort of detracting from climate finance in adaptation. And so we wanted to explore what some of those barriers might be from an actuarial perspective. And we found that many of these issues relate to the fact that it does come down to uncertainty, the uncertainty of the benefits across the future, and the differences in stakeholder interests, and the costs today. And on that note, I'm going to pass to Ramona for our next segment.
Thanks, Kate. So Kate's outlined the need for climate finance and some of the key challenges and barriers to current levels of investment. Globally, around $630 billion per annum US was invested in climate finance, being it adaptation and mitigation activities over 2019-2020. And as Kate's noted, only around 5% of this has flowed into climate adaptation. In addition, if you look at some of the global studies of the scale of finance needed every year between now and 2030, it's around 10 times as large as that. So these two pieces of evidence point to inefficiencies in the way that we are generating investment dollars, generating and directing investment flows. And so today's about ways that we can more efficiently attract and allocate capital, because a failure to efficiently do this when we're making climate adaptation and mitigation investment decisions or decisions you make in your businesses, if we do this inefficiently, what we're doing is increasing long-term costs of climate change. We're reducing the speed of the transition and less adaptation actions being taken. So it's really important that that big spaghetti diagram gets directed properly. The situation we're in is the aggregate result of millions of investment decisions taken. And so we're zooming in today on climate finance frameworks, which are effectively the ways and frameworks that govern how decisions are made around climate adaptation and mitigation investments. A framework helps investors identify, measure, and make climate mitigation and adaptation investments. And the key components of a framework are shown on the left of the screen. So first, clear definitions about what constitutes an investment in climate mitigation or an investment in adaptation. What is a green bond? You need to define in quite a specific level of detail. Secondly, data collection and measurement guidelines. Thirdly, analytic techniques that incorporate climate risk sufficiently into decision making. Also, monitoring processes that include quantitative and qualitative metrics and ensure that the framework is working as intended. And finally, the critical importance that Kate has touched on of including non-financial and difficult to measure elements within the framework. So the EU has one of the most established frameworks of this nature, the EU Sustainable Finance Framework. Climate is one of several pillars amongst the broader coverage of this framework, but it's a good place to start. And I understand many of you in the room would know this framework much more closely than me. But essentially, the EU taxonomy is the core pillar of the framework. And that's setting out to define what sustainable investment activity is, what is sustainable investment activity, under which circumstances. This also provides clarity to investors and companies making these decisions about what constitutes a sustainable investment, and it enables them to measure the degree of sustainability in their business activity. Secondly, a key part of the framework is disclosure. So disclosure provides clarity and certainty for reporting. It offers investors relevant, reliable and comparable information. And so this is a framework designed to enable and direct the flow of finance into sustainable activities, some of which are climate. And just to point out that there's mixed evidence emerging on the flow through from disclosure, despite this being a very leading framework, from disclosure of climate risk through to actual asset price and valuation impacts. So there is work to be done that highlights the criticality of monitoring impact of such frameworks. We're not saying they're a panacea, but we're saying that they are critically to directing finance. Now, frameworks are developed, while the EU Sustainable Finance Framework applies primarily to financial companies with a base in the EU, comparable frameworks, climate finance frameworks, have been developed in other regions and other sectors. So displayed on the screen is a climate finance framework for water and transport infrastructure in the US. So developed in a very different setting. And the key thing to note is that the principles are the same in many respects. This framework was developed in response to recognition that the current approach shown on the left to delivering water and transport infrastructure and making decisions in those settings was broken. The traditional approach overlooks climate risks and costs, just in instances ignores them or has very limited ability for them to influence decision making. There's inconsistent climate-related data collection and measurement processes, so how we define flood risk, for example, and how we assess the potential impact is being done inconsistently. And often the project financing is based on really unknown or different views of climate risks, costs and benefits. So using a set of quantitative research and interviews with practitioners and academics, the Brookings Institute examined ways to make this framework more effective for investment decisions that would support a resilient built environment, and they developed the framework on the right. So the key things to note in this framework are many of the principles are the same. Defining what resilience means for particular infrastructure assets, improving climate measurement and data collection to enable infrastructure owners and operators to align their climate strategies around these common definitions, and consistent recognition of climate risks, costs and benefits. There are also disclosure and policy changes recommended as part of these settings to spur more investment in resilient processes. So climate finance frameworks have these common components of definitions, data collection, analytic techniques, consideration of non-financial measures, and monitoring processes to monitor impact over time. And upon consideration, we think that actuaries probably have the largest role to play in analytic techniques. So many of the analytic techniques we use when making long-term investment decisions simply don't allow for climate risk, we would say, in a robust manner. And just to illustrate that, when you're making investment decisions, in practice, cost-benefit analysis is the most commonly used technique. And that would typically involve, projecting out your cost and benefit cash flows over the lifetime of the project, and then monetising all impacts and discounting them back to net present values. And then you go with the project with the highest NPV. So sometimes, would you believe, climate risks and costs aren't even factored into those costs and benefits? And so a good place to start is ensuring that you've had the discussion with your project team or working team as to whether they are material. And if you decide that they're not material, by all means leave them out. But we would argue that in many investment decisions, particularly in insurance and infrastructure contexts, they are critical risks to consider. And so when we bring them in, that can be done in a number of ways. You can either use a kind of single best estimate set of climate costs, which assume a projected view of the future that there's some agreement around, and or a more sophisticated approach is scenario analysis. So essentially conducting several cost-benefit analysis under different climate scenarios. And climate scenarios are readily available. And thinking through and making your decision, looking at costs and benefits under different future states of the world. And we can get even more sophisticated than this. So when investment time horizons are extremely long, it's important to realise that there is considerably uncertainty or unquantifiable risk around what climate change, what costs and benefits it will cause in the future. So one way to manage this uncertainty is through more sophisticated approaches, including adaptation pathways and real options, that place a value on flexibility in investment decision-making in situations where material costs are highly uncertain. So adaptation pathways is an approach where you will enable pathways of investments, and typically you will make smaller investments until certain triggers in terms of climate are hit. So in the case of sea level rise, you might first prioritise investing in low cost measures or low intervention measures such as dune restoration, nature restoration around coastlines, relocation of easy to relocate assets, before you invest in a seawall. You would then invest in a seawall once sea level rise had surpassed a predetermined threshold. A real options analysis follows the similar principles of allowing for flexibility in investments over time. It applies financial option theory to real-world decision-making settings and can be used to determine optimal investment timing and sequencing. And more detail on the application of real options analysis to flood risk can be found in the SOA report from December 22 on flood risk management and adaptation under sea level rise uncertainty. But we've talked a lot about financial costs. I will now pass to Alison to discuss non-financial and hard to measure costs.
So I'm going to be really quick so Sylvia can talk about the quant stuff we all know and love as actuaries. But the point here is really that a major component that is frequently perhaps ignored or not well dealt with is these indirect social, non-economic costs. Going back to the report that Kate mentioned from Deloitte, they actually show in the aggregate the cost of natural disasters growing to 73 billion per year, just in Australia, by 2060. But you can see if you look at the large graph there, the biggest block is the flood, and that splits out 35% into asset damage, so the things that we in insurance find easier to measure. And moving across, then you get into the other financial elements, the contingent business interruption, the loss of agricultural product, those kind of things. And then even more difficult, the social costs, how to measure, how to value them. They don't fit easily into a CBA analysis at all. So these kind of measures, though, are equally important, particularly things like health and mortality. So how do we go about addressing and incorporating those into a framework that isn't really built to put measures on them? And this, I think, argument is where actuaries come into it. Because if there's one thing we're very good at, it's dealing with the uncertainty, the projection, and coming up with a sensible and reasonable basis to try and incorporate those using social discounting. And then we come to the more difficult question about how to measure if particular adaptation actions will improve resilience. So what we've looked at as a working group a little bit is a couple of different resilience indices. These are just examples. One of them is actually used by the NDRRF, and that's the Australian Disaster Resilience Index. The other one comes from a group called Minderoo, who's done some really interesting research as well, looking at flood and fire resilience, particularly with elements of social cost. Won't go into the details of the indices, but the thing that really stands out is one of the most important and cost-effective measures that can be done is building community togetherness. It's to do with social cohesion, sharing of information. This does not purely come down to the financial situation of the community, but it is how they deal with and respond to disasters. So the big question that leads on from looking at these resilience index, how do you improve the resilience of these most vulnerable communities? And in many cases, it's just now coming through the kind of actions that need to be taken about not just the wide sharing of information, but how do you build leadership in the case of those kind of natural disasters into the resilience index. Oh, I know, I'll go even faster. I won't talk to this one because Sylvia does need 5 minutes at least. This is more making the case that if we're going to be doing resilience building, let's not make the problem worse by generating a whole lot of carbon in the process of doing seawalls and such, and really look at how do you actually incorporate co-benefits and reduce. And won't go too much into multi-criteria analysis. I'll pass straight to Sylvia so she can pass on.
Thanks very much, Alison. As the other speakers have well mentioned, climate risks are highly context and location specific. Australia's unique context requires us to customize the design for climate financing and adaptation, which I'll cover in my section. Australia's per capita GDP ranks top 20 in the world. The country has very highly skilled workforce, well-developed institutional capacity, and a robust legal framework, suggesting its capacity to establish sophisticated climate finance and adaptation framework. Australia also has a highly efficient financial system characterised by a strong regulatory environment, advanced technology, and deep liquid capital markets that can mobilise financing for disaster risk transfer, allowing the nation to focus on medium and long-term planning. The country also has a sophisticated government adaptation investment decision-making process, which involves various government agencies, stakeholders, and scientific experts. You must be wondering what's the commonly adopted methodology for quantifying risks in Australia. In Australia, cost-benefit analysis is the most prevalent quantitative method used, particularly in public sector. The National Climate Change Adaptation Research Facility has developed the guidance for assessing economic benefits of climate adaptation projects using NPV methods. Various government agencies, including the Departments of Environment and Energy, and the Department of Agriculture and Water Resources have incorporated the use of NPV methods into their projects' evaluation frameworks. Demonstrated as the example here is the Brisbane River pre-feasibility investigations into flood mitigation options. There are several limitations revealed from the assessments using NPV and CBA, which I won't cover, but among these, I'd like to highlight some of the greatest limitations. Firstly, the expected loss approach underestimates the impact of severe disasters. As illustrated on the graph on the left, a catastrophic event, despite having astronomical losses, often results in lower expected losses than smaller events after weighed by its frequency. This can often cause bias in decision-making, favoring smaller investments that doesn't provide sufficient resilience. Secondly, climate adaptation plans need to be long-term focused. Over a longer time horizon, there is a considerable increase in climate risk and great uncertainty. Based on Brisbane River flood study, the predicted peak flood level at Brisbane Gauge in a 1-in-100-year flood in future climate can be the equivalent of a flood of 1-in-500-year flood today, which is much larger in size. Real option analysis is a more flexible method that considers the uncertainty associated with long-term investments in the face of climate change. It enhances decision makers to evaluate the value to delay investment options, to gain more information on future climate over time, and the potential benefits to alternative strategies. It has been adopted in Australia in coastal adaptation, fire management in the Alpine region, and water recycling projects in Australia. Particularly, it's popular in infrastructure investments, where the costs are high and the projects have a long-term lifespan. An example of coastal adaptation design for lake entrance in Victoria, as demonstrated here, mitigation decisions are analysed based on trigger points. The starting point will look at low-cost, low-regret activities, such as minimising exposure of new assets. If the first trigger point is seen, which is when a planet is inundated for more than 5 days a year, causing frequent disruptions, stringent control over new developments and preparation for relocation will be actioned. If seeing second trigger of 2 1.8-metre flood happening in a year, impacting the viability of all critical infrastructures, managed relocation of all low-lying critical infrastructure and dwellings will kick off. In the worst scenario, when the barrier dune is breached and the ocean waves breaks on the town, it's very likely to lead to permanent inundation for low-lying area. Actions from the future generation will be required to re-evaluate the design. Real option method is gaining popularity in Australia with its clear advantages that Ramona has mentioned. One of the advantages that I would like to highlight is not only allowing current generation to participate in project evaluation, but also will involve future generation when the time arrives, creating the opportunity for knowledge transfer and continuation of adaptation planning. Practical implementation of climate adaptation requires us to go beyond quantitative methods, and there are other international frameworks to address integrated assessments and to engage a range of stakeholders. Whole-of-a-system approach considers the interdependent nature of various systems and sectors. Climate adaptations need to be actioned alongside emission reduction, and only in this way adaptation can be feasible. Natural capital needs to be considered in economic evaluation. For example, the system of environmental economic accounting, which is system integrates environmental information and natural resources accounting into the national accounting system, and the economic indicators such as GDP. It provides a framework for measuring and analysing the interaction between the economy and the environment, and the contribution of natural resources to the economic activity. Climate adaptation also requires action from the whole nation. It needs to be place-based, community-based, and value-driven. As emphasised in the UN Disaster Risk Resilience Conference happened last year, there has to be collaboration between households, private sectors, and public sectors. Australia's First Nation should also not be forgotten as one of the most important stakeholders. the Indigenous communities have been developing long-term knowledge of the land and its ecosystem, which is critical in providing strategy for disaster resilience. In the aftermath of 2011 Queensland flood, the Brisbane City Council worked with the Aboriginal community to develop a flood recovery plan to incorporate traditional knowledge. In another example, mosaic burning, which is plant burning of different patches of vegetation at different times of the year, is culturally practiced in Indigenous communities such as Arnhem Land in Northern Territory, and has its significance in fire fuel reduction, creating biodiversity conservation, and preventing catastrophic fires. In a holistic approach, social, health, well-being, and other intangibles will need to be included in the assessments, and holistic financial solutions will need to be implemented to complement physical measures and mobilize capital at all levels from the economy to support climate adaptation. This particular stream is where actuaries can greatly contribute to enhanced protection and risk management mechanism through the designing of insurance products, innovation in market-based risk transfer, and for those working in public sectors to contribute to contingent financing and budgetary instruments.
I think we need to come to the conclusion. We are really pressurized by the organizers to keep...
Our conclusion maybe? And go straight
Yeah, sure.
Yeah, sure.
Yeah, well, many thanks for this huge amount of insight, and I think that we have maybe to discuss what to make all the ideas be happening in practice. Many thanks, ladies. And I've seen some questions popping up here on the system, and I like only one to be dealt with now, and we will deal with the others at the end of the session. But there's one question which relates directly to your presentation. It says private sector investors, they want direct return on their investments. Many of the returns on adaptation investment are not directly monetized. For example, lack of physical and social damage. How can we find ways of producing revenue streams from adaptation investments that will be attractive to investors? I think this is a decisive question. Do we have any idea?
I think this is where the stakeholder interests get really complicated. And this is probably one of the bigger barriers because, you know, a private investor alone isn't going to be reaping the rewards of the investment. It's society at large or nature, all those indirect benefits. And I think that's where there is a clear role for public and private partnerships. So the government does have a role to play. And I think the benefit isn't realised if it's just one asset over here and another asset over here. A whole of system approach is required. So it's the incentives there, or the right frameworks and the right direction, planning, building codes and systemic pieces to think about that whole region is important. And we heard that from Jackie Jordan earlier today, where they're looking at the 6 cities around Sydney and how they think about this as a system-wide approach. So I don't think it does stack up for individual private investors, and that's one of the key barriers. It's a system-wide approach, public-private partnership, looking at the range of solutions across the system.
Yeah,
further to add?
maybe just add, I think the other key element here is to do with the measurement of natural capital, and this idea that somehow nature is a free asset, that we don't have to put a value on it, because I think now that we're moving to TCFD and TNFD, which is the Task Force for Nature-Based Disclosures as well, corporates do need to incorporate that into their kind of investment decisions as well. So this, what gets measured gets done, right? We heard it this morning. This piece of actually being able to come up with essentially a full picture of what is the value of the firm, including natural capital and the social elements, is really important. So building that into the wider framework and then looking at your IRR once you put a value on those as a corporation. So for instance, think about agriculture, somebody might say, well, it doesn't really matter what goes on with my watercourses because I'm just looking at my farmland. But in fact, it's very interactive that the health of the watercourses in the same area will feed back into long-term what the value of that agricultural production is.
Yeah, well, I think the message is it's not just one institution taking action. There's some question in that regard. Who shall be the one? Who is the addressee of what you have been coming up with? And they're like, but this is similar. Who shall take action? And this, I take from what you say, there's a collaborative approach, the government, the investors, and maybe insurance companies, they have to take action. This needs to be somehow coordinated, everything. And I would take this matter as an item to the Q&A and the discussion phase at the end of the next presentation. Let's keep it in mind. This is something we can really elaborate on a bit further. Thanks, ladies, for the presentation. And I have